Good morning, everybody. Thanks for taking the time out of your morning to join Mark and I today for our fall market update. We have some things that we want to share with you, and before we get to the content, we just wanted to, one, say thank you for all the suggestions that you've given us on how to improve past webinars. We're still learning and improving and want to keep using this tool, and so it's really important, if we forget at the end, to just ask you up front, make some notes, and don't hesitate to reach out to either one of us or your advisor and just offer any feedback or suggestions, good, bad, or indifferent. It's all good. It's all welcome. So please do that. Also, just want to say we also really value your time. And so as we get into the slides today, in the past, we've run about an hour. We're going to try to cut it down from an hour. We're shooting for 40 to 45 minutes. Mark and I, as you might imagine, went through and had to cut all kinds of slides. We find all this stuff fascinating. So we really tried to boil it down to some more topical and important things, just to give you our thoughts on things that matter the most and we get a lot of questions about. So with that said, why don't we go ahead and get started, and I'll lay out the agenda for today's webinar.
Oops. Oh, hang on a second.
All right.
There we go.
There we go. Okay, so major topics, interest rates and inflation. Again, this has been a major topic for quite some time. I'll address that momentarily. And then we'll turn it over to Mark to talk about the recession that never was. We'll talk about why diversification is more important than ever. And we will close with our thoughts on looking ahead into Q4 and beyond. So why don't we start with interest rates? So we've talked about this for the better part of 2 years. It's been the dominant story, and interest rates and inflation have gone hand in hand. Basically, this graph is just illustrating that since the beginning of 2022, so really over the past 7 quarters, the Fed has been on a mission to slow inflation. That's really what this boils down to. And so these rate hikes, you can see at the beginning of 2022, we were near zero at 0.25%. There's been 11 hikes over the last 7 quarters to current level about 5.5%. That has been a historically fast increase in interest rates. We'll talk about the impact of those momentarily, but the Fed is basically giving signs that they're nearing the end of these rate hikes. Just the minutes that came out yesterday from the September report indicated that we should expect either no further increases, but possibly one more quarter point increase between now and the end of the year. And the other thing that is very clear is that if and when they announce that they're done hiking rates, that they do plan to keep the rates at this higher level into the foreseeable future, at least well into 2024, to make sure that inflation doesn't start to run away again. So talking about inflation, next slide. The goal of these rates, as we just said, is to bring inflation down. So you can't bring it down all at once. You can see in this chart, which is a little bit dated, that back in middle of 2022, the year-over-year inflation reached a peak, reached a high. The interest rate increases have continued to have an impact on inflation, which means certain costs of goods are starting to fall by comparison to where they possibly were headed. You can see that over the last probably 9 to 12 months, inflation has been brought down considerably. June 2023, it was at 3%. Last month, we were at 3.7. In fact, the CPI index that just came out this morning for this month has us again at 3.7. So we reached 3% at the end of June, but now we've had an uptick. Obviously, all consumers have felt where that has been. It's been a spike in oil prices, and we've all seen that in the price of gasoline and energy. So the goal for the Fed with inflation is ultimately to get it down to 2%. And based on the trends, it looks like they're heading in that direction. Next slide. So we're still in an inflationary environment. Hard to tell how long that may last. But really, this kind of just lays out and illustrates three different categories between inflation, where we are now, deflation, when things go dramatically the other direction, and kind of this very challenging area called stagflation. We were talking yesterday, and we're really in a phase where we're teetering between inflation and stagflation. And really the only thing that's holding us back into a stagflation type of economic environment is if unemployment goes up. So the Fed has a charter to try to keep growth moving forward, try to keep unemployment from rising too much or too fast, and all the while try to keep some modest level of inflation. Inflation always sounds bad, but the objective for inflation and a healthy rate of inflation is between 2 and 3%. So if they can keep all these things in check and hit that 2% number, keep unemployment low, and somehow have some economic growth engines driving us forward, that's the soft landing they've been seeking. Otherwise, it may be a bumpier road. But right now, we're in between inflation and stagflation. Next. So interest rates are having an impact on inflation, which is the Fed's goal. But of course, with rising interest rates, there's going to be some dislocation in asset prices. We've certainly seen that. We'll talk about the yield curve. We'll talk about higher interest rates and what it means to asset prices temporarily. And so, Mark, go ahead and go to the next slide. Just to, at a real high level, talk about impact across global asset prices. The first 6 months of the year, after a pretty disastrous year in 2022 for investors, we were able to benefit from a rebound, mostly with stock prices. Bonds have been under pressure the entire time. But then in Q3, we had a setback here. You can see that every asset class was down. And this is not completely unexpected given how fast these rates have increased. The rates are certainly slowing inflation down, but they're also making it difficult for investors to see clearly. And it's also starting to place some stress on corporate earnings and certainly bond prices. Next slide. I found a slide that said good news and bad news with interest rate hikes in the background, which I thought was kind of interesting. In most instances, it does feel like it's bad news. It feels like everything costs more, everything is, it's more expensive to borrow, et cetera, et cetera. And I'm not discounting that those are frustrating byproducts of interest rate increases. But when we have clients that we talk to, we just want to reiterate that the good news of interest rate increases, certainly for our clients, but maybe not for everyone, is the majority of our clients have amassed significant assets, typically have quite a bit of liquidity. And if they have debt, most of this debt is fixed debt, call it home mortgages that were refinanced at 3% or lower back in recent years when we had really low rates. So the good news for our clients is as net savers, your cash is finally able to generate yields that we haven't seen in a very long time. Many clients have been talking to us about how to optimize their cash savings with all that liquidity. And net savers are actually in a real good shape as opposed to net debtors, which are people that need to either come off fixed loans and go into interest rate or variable interest rate loans, or people that need to borrow money for the first time, younger people trying to buy a home, people trying to buy a car, people that don't have the cash in the bank to be able to benefit from these higher rates. They're going to see some challenges. Next slide. So we talk about bad news. Okay, so bad news, bond prices. So if you haven't been following the news, because the news typically follows volatility in the stock market, one area for investors that's been really difficult here since the beginning of 2022 is there's just been significant pressure on bond prices. We've talked about this in past webinars, but bond prices move inversely with interest rates. So when interest rates rise, and certainly when they rise quickly, bond prices tend to fall. So we've definitely seen this. You can see in the far right area of the chart as we get into 2022 and 23. These, by comparison, over the last 30 to 40 years, has been one of the most challenging times for bond prices in recent memory. However, Oh, the however is the next slide after this. Okay, so yield curve. This is something that we look at closely. It's been in the news, but just to kind of reiterate what's happened over the last 9 months, the yield curve remains inverted, which is something we've touched on in the past, which could be an indication of an economic slowdown. Mark will talk about recessionary pressures here in a little bit. But you can see that from the green line, December 31 of 2022, up until the end of last quarter, September 30, the yield curve has essentially stayed the same as far as the shape, but we've seen that there's been interest rate increase across all durations of the yield curve. So all that means is that bond prices, despite whatever their durations might have been, all aspects have been under pressure. So now the however slide. However, as we see bond prices under significant pressure, the good news is that we have yields coming off all financial instruments that are much, much higher than they were in previous years. You can see in this chart that the red bars indicate where rates were at the end of 2021. The blue bars indicate where we are as of about a week ago. And you can see dramatic increases in the level of yields and interest income that we're expecting to be able to generate from our bond portfolio. This is a very welcome change, despite the volatility that's taken to get here. And it really does bode well for generating low volatility income in the future. So this is actually a positive output from the interest rate increases. It's just going to take some time for bond investors to be able to recoup some of the pressure that the underlying bond prices have been under. This one here also kind of supports what I was just mentioning. So we talked about that there's an inverse correlation between bond prices and the increase or decrease in bond rates. This is a little bit noisy, but if you look at the very bottom of this graph, you can see that the blue bars are basically a projection of what happens for certain types of bond instruments for a 1% decrease in interest rates. And conversely, you can see what happens with the gray bars if there's a 1% increase in interest rates. Well, where we are today, we feel that we're hopefully near the end of the increases. So you can see that the upside if interest rates should contract by as little as 1%, we just feel that our bond investment side of the portfolio stands to have a lot of upside. Maybe not in the immediate future, but certainly over the next couple of years. And lastly, and this is just, and I'll turn it over to Mark after this one, we found this slide to be really interesting, and it supports kind of a bigger look back behind just going to the beginning of 2022 with all the inflation and interest rate stuff. So we just wanted to kind of pull this up. We'll talk about diversification later. This is a representative sample of what a globally diversified 60-40 portfolio has done, going all the way back to the end of 2018. So some clients that I've met with, it helps bring perspective, even though the ride has been particularly bumpy here in the last 12 to 18 months, is kind of taking a look at how a well-diversified portfolio, such as the one we typically construct for you, has worked. So if you go back to the beginning of 2019, you'll see that the annual returns for 3 years in a row between 19, 20, and 21, we were able to navigate that dramatic fall in March of 2020 to get through the COVID drop. And then we saw nothing but uptick all the way up until 2022. You can see the correlation of as soon as the interest rates started to have an impact on bond and stock prices in 2022, you see that was the down year. But then you see 2023, a 60-40 globally diversified portfolio through the first 3 quarters up about 6%. Not a tremendous recovery, but nonetheless positive. So one thing I want to focus on is the red line from the beginning of 2019 all the way till present day. we've seen approximately a 40% increase in the value of a 60/40 portfolio if you remained invested. The annualized rate of return over that period, about 57 months, 7.3%. So despite all the volatility, we hang in there and we stay diversified. This has played out well. The other thing I'll just point out is 2023. It doesn't show in this chart, but typically it's the bonds that provide support when we have periods of volatility in the stock market. Well, in this case, it's flipped around. We've had a lot of volatility in the bond market, and it's stocks that have helped mitigate the volatility here over the last, certainly since the beginning of 2023. Stocks are up, bonds are down, everything all included. We have a portfolio that's sitting highly appreciated from where we were about 5 years ago.
Okay, so do you want to take over? Okay,
yeah,
so
go for it, sorry.
The unofficial handoff. So thanks, John. That was good stuff. So by the way, I am terrified about the tech thing. Last time I guess I showed all my notes. So basically, I put a request in to fire the tech person, which is me right now. So hopefully we have a replacement next time. Anyway, so what I'm going to talk about is kind of where's this recession that everybody has been expecting. So now we're in the fourth quarter of 2023. And I think this recession was supposed to happen in the third quarter of 2022. So this recession, I guess I'll call it the recession that never was, but could still happen. So we're going to kind of go through and talk through why this recession or this potential recession could be delayed or not happen at all. Okay, so with that said, there is a discrepancy. I'm gonna get my little laser pointer here. Let's see here. There's a discrepancy between what people expect both on Wall Street and Main Street. Okay, and this is kind of interesting chart that came out last week. Basically, what it shows is Goldman Sachs, Bank of America, have a 15% and call it a 40% chance of a recession. I think they said in the next 12 to 18 months. But you look at Main Street and the average CEO, according to the, my glasses aren't, let's see here, the CEO conference board is 84%. And Main Street, you and I, 69%. So basically, everybody's expecting a recession except for Wall Street. And so John and I were kind of joking about that yesterday is, I'm sure Wall Street is making money somehow on this discrepancy, but it's just kind of an interesting paradigm. So let's talk about these recession triggers that people have been talking about. Let me get this off here. Higher interest rates, which John talked about. I'll show you some examples of how high they actually are. Loss of purchasing power. This is the inflation thing. John and I and Dan, we were talking the other day about the visibility of inflation these days. It's, we've heard of inflation, but it's like every single time we go out to dinner, or we buy something, I don't eat McDonald's hardly ever, but I was craving a sausage egg McMuffin that used to be 2 for $2.99 or $1.99, and it was 2 for $11. And so, and it's just everywhere you go, it's just like, you just can't believe it. And so that's kind of trickling through the system, which eventually will change people's buying behavior. Also, we have the stimulus running out. So during COVID, we had all this PPP loans, ERC loans, which is the employee retention credit. And some of these things are kind of coming to an end. And just to give you an idea of how much stimulus this was, PPP loans, we could have qualified, ours Crum for a PPP loan, even though we, weren't, our revenues weren't down 40% or 50% like some of these people. We didn't take it, but you didn't even really have to qualify and show hardship to really get PPP loans. ERC, the employee retention credit, unless you have a company, you may not know that they were offering, if your revenues went down in 2021, 20%, they would give $7,000 per quarter. Each quarter, you were down 20% per employee. So if you're a business with 100 employees and you were down 20% for an entire year, you would get a check for $2.8 million. Okay. And if your business recovered quickly, like a lot of businesses did, that's just excess cash. And that's why I think that's why you see all these people with boats and vacation homes and RVs and Sprinter vans and all this stuff, is a lot of that money was used for discretionary spending, not just to maintain their employees. And so that is now coming to an end. So over the next couple of months. So that's going to be a drag possible. Student loans are reinstated. So as of, I believe it's this month, or maybe it starts officially November 1st, is the hiatus on student loan payment has ended. So I'll show you just in a second how many student loans are out there and what it could affect things. We got 33 trillion in debt, so that's obviously leads, the more debt you have, the harder it is for economies to grow. Real estate affordability, obvious. Geopolitical conflict. So these are all kind of in the mix, factors working against each other, but still we don't have a recession. So let's talk about just some of these real estate effects. Average home buyer, and I'll get my little thing, since the average mortgage payment prior to COVID was, I don't know the exact number, but it was like, $1,300, something like that. Now it's $2,600. So I did show, this is one of the charts I took out, the average mortgage, 30-year mortgage right now hit 7.84% last week, which is unbelievable. Student loans, I mentioned 40 million people have student loans that have not been paying interest or principal for the last 3 years. That's going to be a huge, or headwind, because these people, that's like, for some people, if their loans are big enough, that's like another mortgage payment. So that's going to lead to possibly less spending. Average credit card rates. So as these rates have gone up, the good old credit cards have never missed an opportunity to take advantage of everybody. And this is the average rates according to what type of card, and they're just mind-blowing. You just can't believe it. Average auto loans, I have an auto loan still that was like 2.4. Now you go out and it's 7 to 8%, if not higher, if you have bad credit. But here's the interesting thing about all this stuff, and this kind of leads to the point of why has there not been a recession and yet? And I think it's because people have underestimated how the financial position of the average American. And so basically, this chart right here shows pre-pandemic versus now. And so this right here, this green line is the credit card, utilization. So credit card balances. Okay, so if you go back to 2020, we're about, right here. And even though it's ticked up quite a bit in the last 6 to 12 months, we're still under the pre-COVID level. Okay. Home equity. Okay, so home equity, pre-pandemic, we were, right here. It will basically take a step back since like 2008 and 9, since the Great Recession. That's when the Fed lowered interest rates to 0% for the last 10, 12, 13 years. Everybody took advantage to refinance and at lower rates. And so their payments are lower, but also their property values have gone up. So the utilization of that equity has been going down and is still very low. Now, granted, people don't want to tap your line of credit to do a kitchen remodel now because your line of credit's now charging 9%, right? So that's something that something to watch as well, is like how the remodel market and renovation stuff will be hit with these higher interest rates if they have to tap their home equity line for that. So this is a chart we were debating to whether to put it in or leave it in, and it was out and it was in, but I think it does play an important role. And basically, one thing I think is important to understand is the Federal Reserve. What are their tools? Okay, so basically, the Federal Reserve provides liquidity to the market, or they extract liquidity. So if the economy is in a decline and they need to spur growth, they lower interest rates and add more liquidity. If it's the opposite, they raise interest rates and extract liquidity. So as you can see, since 2020, this is all that PP, all this stimulus stuff, but they have since last year have been extracting some of this liquidity, $1 trillion. Granted, there's still a long way to go, but that could very well be just as important, if not more important, than interest rate cuts. Because if they have to, and the reason they're extracting this is because they want more ammunition if in fact we do hit that slowdown and there is a recession, whether it's a soft landing, hard landing, or whatnot. This is a chart. Again, this is another one super busy. Sorry. But the reason I left it in here is liquidity in stock markets and bond markets are pretty tightly correlated. And so what this is, this red line is the liquidity index. So this is high liquidity, low liquidity. This is the S&P 500. So you can see basically, this is since 21, but if we went back, you would see something very similar. Is the more liquidity in the market, the better stocks perform. And so it'll be kind of interesting to see this divergence here, what happens, because they've been extracting liquidity, but stock prices are still pretty inflated. So I think a couple of things could happen. One is stock earnings have to go up to make the prices more valuable, or the Fed might have to provide more liquidity but basically they're going to have to make a choice eventually if we do have a slowdown, is whether they want to save the stock and bond markets, or the flip side is the currency will take a hit. So anyway, moving on. This is this is my FOMO section. So fear of missing out, because it's quite prevalent right now. I'm going to talk to you about the Magnificent Seven stocks in just a second, actually right now. So this is a chart that we've shown in the past quite a few times. And basically what it is showing is the top 10 stocks in the S&P 500 going back a good fair amount of time. So these top 10 stocks represent 32% of the S&P 500. So, we've been asked, should we buy some Tesla or some Amazon or Microsoft, Google, and stuff like that? And basically, if you own the S&P 500, you already have 32% of that. So, you could, but you already own a lot of it. Okay. Down here is kind of another dichotomy, is the earnings contribution of those top 10 stocks has been going down. So the prices are going up, but the earnings contribution has been going down. And so it's just something to watch. Now, this next chart I think is pretty darn incredible. So what this shows is this is the S&P 500 returns this year. And so as of October 6th, the S&P 500 was up 11%. But if you look at this, 10.94% was from the Magnificent Seven. And only 0.06 was from the other 493 stocks in the S&P 500, which is just mind-blowing. So that's a pretty significant indication of FOMO, fear of missing out, because basically people are buying a lot of that stuff. So it's something just to be careful of. Now, granted, these 7 stocks are phenomenal stocks producing incredible earnings. They have wide moats, tons of cash. And what's also just kind of interesting is some of these companies like Apple and Microsoft several years ago, they they actually, even though they had a ton of cash, they floated bonds and issued bonds at like 2 or 3%. And just as ammunition, just taking advantage of the low interest rates. And guess what? Now they've taken that money and now they're earning 5% in a 90-day treasury. So they're actually, when you look at their earnings reports, they're actually making money on those bonds that they issued, which is pretty damn smart. And so anyway, with that said, this is a chart that is that kind of shows the danger of this stuff. So basically what this is saying is the 10 largest stocks, so this isn't the Magnificent Seven, but they're probably in there, is this is a lead up 10 years. These are the annual returns of those stocks. 10 years before, up 12%, 5 years before, this is before becoming a top 10 largest stock, 20%, and then 3 years before, 27%. Start of the first calendar year, once they reach that, this is how they've performed 3 years after, 5 years after, and 10 years after. So the point is, these are great companies, but the price you pay for these great companies can matter. And it eventually will matter if valuations get completely out of control. So that's just kind of a cautionary note. Here's another chart that kind of illustrates diversification and why it's important. This is a period between 1999 and 2009. So this is the decade of the dot-com bubble and bust and the Great Recession. And basically, the S&P 500, we've talked about this, but this is called the lost decade. Actually, over that 10-year period, was actually down 0.9% annualized. So you didn't make any money. I think if you include dividends, it was flat. But if you had just taken those S&P 500 companies and equally weighted all 500 companies, you would have earned these returns. The S&P would have earned 5%. So again, the lost decade got ahead of itself with the concentration of a few stocks, and a lot of these were tech stocks as well, that didn't live up to the earnings and the valuations. Okay, so I talked a little bit about diversification. So this is, diversification. Warren Buffett says diversification is kind of like stupid, because he thinks that every expert can buy concentrated positions if they do enough research. But the reality is people don't do enough research. Okay, so the rest of us have to and should diversify. So what this shows is the different classes: large cap, developed market equities, different bonds and stuff like that. So if we had a balanced portfolio, really what we're trying to do is have a ride that is less bumpy than if you take, for example, emerging market equities. If you just follow the purple, it's all over the place, right? And so most people don't want that much volatility. So that's what we mean by diversification. So now I'm going to show you kind of just an example. And for some clients, I've shown this to you, or we've shown this to you, but probably quite a few haven't. So this is, as we're building portfolios, we have US stocks, non-US stocks, we have large companies, small companies, we have value stocks and growth stocks. And we won't get into that detail because we've talked about that in the past. But this is annual observations of value minus growth stocks. Okay. And as you look at this, so every period is a 1-year period. And as you look at this, it looks pretty random. Although if you look at this line right here, value stocks have outperformed growth stocks since 1928 by 4.5% per year. Okay. However, if you look at 10-year rolling periods, so if you take, like 20, let's just say 1999, a 10-year rolling period would be 1999 to 2009, and each year is a new rolling period. So when you look at that, value absolutely outperforms growth historically, okay, except for a few small periods of time, which, during, the 30s, during the dot-com time, and then primarily during this decade or so plus that we've just been through. And so what's ironic, or maybe it's not ironic, is, if you take a step back and say, what caused this? this is when we went to a 0% interest rate. And the Fed the printing presses were going 24 hours a day, and they lowered interest rates to zero. So is this a new phenomenon where growth outperforms value extensively? Or now that we have increased interest rates and the Fed has changed policy and we're facing inflation, are we going to revert back to the historic averages where value outperforms growth? I think I know what's going to happen, but those are the long-term statistics. Okay, now if we go to small, yeah, John.
Just one thought, Mark, on that previous slide is when we talk about being in a zero interest rate environment, and this goes back years ago, we were talking about investors really not having low volatility options. They were basically, in order to generate some growth or not yield per se, but growth, they were forced into growth stocks because there was no yield available on bonds. There was no yield available on cash. So now that there's alternatives that could have lower volatility, it wouldn't be surprising to see maybe not a full violent reversal to value, but we might see an offset to where we've been the last 10, 12 years.
That's a good point. I'm sure that did play a part in that as well. Okay, so going to small cap versus large cap. Again, it looks pretty random, but small caps over the long term, again, same time period, have outpaced large cap by this amount. If you look at that, again, those 10-year rolling periods, it's not as obvious or extensive as the value versus growth, but eventually we are going to revert where small cap outperforms large cap. It hasn't happened for a very long period of time. So for at least the last 5 years or so. So that's another aspect of things. I don't know if we've shown this before. It's kind of a busy chart, but it should make sense. So basically, this is US markets, okay? And just to show you that value beats growth premium. So 1 year time periods, 60% of the time, value is beating growth. 5-year rolling periods, 70% of the time, and then 10 years, 79% of the time. Now, this 10-year, that's a pretty big number, but again, this is the period of time we've just been in as part of the 21% that it didn't work, okay? Small versus large, 1 year, 5-year, 10-year, not as prominent, but still there. And then profitability, high profitable companies beat low profitable companies. That's rather obvious, but the numbers are pretty extensive there. Now, for these we call these factors, for them to be statistically verifiable and useful, you have to be able to, it has to go across different market classes, not just US markets, and over different time periods. So this is developed ex-US markets. So this is like international Japan. And as you can see, the numbers are bigger internationally. And if you go small versus large, much bigger than in US markets. If we go emerging markets, and that's everything else in the world, these are the numbers, and small is actually 10-year time periods is one of the largest numbers there. So you just don't. The moral of the story is you just don't know what's going to outperform and when it's going to outperform. So we try our best to diversify and have all the different classes, but tweak the percentages we have in each depending on where we think we are in the cycle. Okay, so anyway, that's and I'll show you why this is important in just a second. This one I thought was funny, but it's basically, now I'm going to switch to looking ahead. We've seen a rally in the markets followed by since July a big drop, or a pretty significant drop, and then we've seen the last couple of days a rally. I don't know what the market's doing right now. Where are we? Is this basically, are we about ready to get a Santa Claus rally, which typically happens in November, December, January, or is this a dead cat bounce, they call it, or a trap? Okay. This chart, which is busy, but through the use of technology, I can create a red box. But basically what this is it shows the S&P 500, the NASDAQ, the Russell 2000, and the Dow Jones. Before I look ahead, I think I want to look back. Okay. And John talked about the 60-40 portfolio and it's average 7% or so. But if you're in stocks, and we just go back to January 3rd, 22, up through a couple days ago, even though the stock market is up, we almost a year and 9 months later, the S&P 500 is still down 9%. Most people don't realize that. The Nasdaq's down 14%, even though it's up like 50% or whatever it's up this year. And the Russell 2000, which is the 2,000 largest companies, still down 22%. This is interesting because along that ride, that year and 9 months, this is the maximum drawdown of those indexes. So the S&P went down 25%, the Nasdaq 35%, so on and so forth. But this is the number that really stands out, because I talked about FOMO and these 7 magnificent stocks. There's 493 other stocks, right? What was the ride like for them? So this is over that year and 9 months. If you look at the average S&P member, 500 stocks, the average member had a drawdown of 37% over the last year and 9 months. NASDAQ minus 61%, Russell 2000 minus 54%. So we were talking to Dan earlier. It's like, have we already experienced a recession in stocks? Even though a recession could come, it's quite possible that we may have hit bottom. And so, in the next section, I'm going to kind of talk about emotions and stuff like that. So, in our last presentation, we did show a chart that showed that stocks are usually forward-looking, and they're looking 6 to 9 months out of what they think is going to happen, and as far as it's priced today. So I just never miss a chance to make fun of Jim Cramer or CNBC, but I thought this was funny. So let's talk about this fear, the media and stuff like that, because I'm just a caution, because we truly believe that we are going to about ready to get some pretty, I shouldn't say ugly, but some economic reports that are not very pretty looking. Okay, we are definitely in a slowdown. Inflation has ticked up the last 3 months, but primarily because of oil. Earnings have been they've been reverting down, even though they're still positive. GDP is still positive, but the rate of change is going down. And so there could very well be some ugly economic reports that come up in the next three or 4 months. It doesn't mean that your stocks are going to go down. This is typical. I pulled this off a couple days ago from wherever, I guess it was Fox Business. The bond king warns U.S. consumers headed down a death spiral. God, that sounds ominous. But as I showed you before, the consumer still has a lot of ammunition. They have all their home equity, and death spiral. That all that credit card debt we were talking about is only that debt is only 6% of the entire U.S. economy, whereas the home equity is like 70% or some large number. So just be careful of the headlines. This is from Jeff Gunlock. He's the bond king. It was a LA-based bond manager. So we showed this to you. We've shown this a couple times. This is a year ago. This is the CNN Fear and Greed Index. As you can see, this is from 10/19, almost a year ago to the day 2022. Our last, I think our fourth quarter webinar was like the very first part of November. Okay. So at that point, there was a lot of greed. Now, just to keep in context, 10/19, 7 days earlier on 10/22 was the low of the market. Okay. So there was a lot of fear. Today, here's where we are as of 2 days ago. The fear gauge, ironically, is at 34 again. So there's a lot of fear in the market. 1 year ago, today. So this is a chart that I did show, or Dan and I showed a year ago. And basically what it says, again, I hate all these charts, but there's no other way to tell this story without all these numbers. But basically what this was saying is when you had bear markets and you hit a low, a bear market is considered the market's down 20% from its high. what happens after 1 year and the first year and the second year after you've hit the low? This is the exact chart I showed you a year ago. And so as you can see, you have all these numbers, January 3rd, 2022 to 10/12/2022. This is the high, this was the low. The market was down 25.4%, the S&P 500. So we said, well, what do we think is going to happen? Well, if you look at those numbers, we were making a pretty reasonable guess that it's going to be up. And so what actually happened? This is what happened. So 1/3 to 10/22. So 1 year later, the S&P 500 was up 20%. Okay. 2 years later, we don't know yet, but it's looking pretty promising, except for 1980. That's some good news to look forward to. Okay. Here's another way to look at this. This is the total US stock market. And basically, after a 10% decline, a 20% decline, and 30% decline, this is the 1 year average, this color, the 3-year average right here, and the 5-year average. So after 10% decline, markets tend to rebound pretty significantly. After a 20% decline, you can see even more so. And then after 30% decline, even more so. So chances are that we are going to see some decent recovery. Now, it may be a slower recovery because of all the other challenges that are going on, but I just think you need to be careful of getting in a too negative of headspace, because if those economic reports start turning out, or we have this terrible thing going on in Israel, try not to be headline driven is the moral of the story. So let's talk about the fourth quarter. Here's another one. This is when September was, if the market was positive going into September, which it was, and it is normal if you have an up market for it to take a breather at some point. So this is if September fell greater than 3% after having an up year to date. And in September, we were down 5%. This is basically unknown at this point, but chances are that the fourth quarter, if we look right here, forget October, but the fourth quarter, it looks like we should have some pretty significant returns. And we hope, it can always be different. But that looks like, again, hopefully we get the Santa Claus rally. Again, November, December, January are typically the best months in the market. October, by the way, is the worst. Now, this is that same busy chart, but it goes out farther. And so basically, here's that same time period, January top to the low, and we go 1 year is 21%. So the question now, and hopefully I'm showing this a couple of years from now, what's this number going to fill in? What's the 5-year and what's the 10-year? But if you look at these numbers, these are pretty spectacular. Okay. And so in the stock market, it is the US stock market is the US economy. The US economy has grown long-term substantially. And you do go through periods where the stock market goes down, but it is an upward trend. And so again, the message is stay in the boat, stay in the boat. However, we've shown this chart. This is to get those great returns in the stock market, you are going to have some periods. This is what the S&P 500 each year returned, but it is 100% completely normal that you're going to have declines along the way. So it's going to get scary at some point. And so again, that's why being aware of how the media affects our kind of mindset, and having a disciplined investment approach is so important. Now we have to talk about the election a little bit. We've shown a year ago that the election, who's in office, really has no impact on investment returns. But this is kind of interesting. So this shows in year 4, well, each year of a re-elected president, a new president, and the average year. Okay, so we are in year 3 of a new president, and the market averages 20%. during those occurrences. Okay. If we go into next year, because typically, the year before a presidential election, the incumbent is trying to get the economy to look really good so they have a better chance of getting elected. But year 4, kind of interesting. If you have a re-elected president, it's been negative. And it could be because the re-elected president is they're re-elected. Now they can roll up their sleeves and get some real work done and not worry about being re-elected. But if you are trying to get re-elected, you're trying to pull all the levers to make the economy look great. So next year, the average return has been 12%. So again, some possible good news. Now, I do have a caveat. This is this is a McRib. Okay. So some statistics, you can take any statistic and make it and twist the facts. But here's a funny one. The S&P 500 has a higher daily return when the McRib is available. And so if those who don't know it, I've never had a McRib, I guess I should have one, is it's limited release. But 23% of the time, the McRib is out there at McDonald's when the market is open, and you can see the daily return is double. So do what you want, but there's phony statistics. So again, the moral of the story is all those things I just showed you, they look really promising, but anything can happen. And with that, I think I'm done. How'd I do? We went over,
job, Mark.
John.
I'm not sure if that McRib slide made people hungry or want to skip lunch, but excellent way.
Exactly.
Awesome. No, again, thank you, Mark. Thank you, Dan, for your help preparing for this. And thank you, everybody, for attending. We are recording this session. We'll make sure that a link goes out to all clients. Not that you need to watch it again, but you're welcome to. But certainly anybody that missed today, we'll make sure that they have an opportunity to see this. And lastly, again, please, any suggestions, any feedback on how we can continue to get better at this, we welcome that. And that's it for today.
Also, the next time we do this, we'll send out, in advance, an email to request questions, because we do want to address make sure that this is most useful for you. So if you have questions now that we just couldn't get to, or you think of them later, just feel free to reach out to us, and we're happy to address them. So with that said, thank you very much.
Great.
And you all have a good day.